Can you hear me?
Can hear you, but we see your slide number 7. Is it by intention, by design, or?
No.
Okay, perfect.
Okay, that's it. Okay. Good morning, good afternoon, and good evening, depending on where you are. So I'm so happy to share my thoughts after hearing several other scholars talking about what data information can do to finance. So what I'm talking about here is some joint work by my fellow colleagues at Luohan Academy, including some of our fellows who work together. Okay, so we all know the value of finance. So finance in nature is a service of individual information. So the two keywords, information and individual, corresponds to two key obstacles of finance. They are information costs and the lack of scalability. So if we look at the current financial system, let's see how it deals with these problems. If we first look at the financial accounts, then globally, there's even very recent where there's still about 1.7 billion people who do not have bank accounts. Now, if I quote the seminal work by Kotelek back in 1998, The Money is Memory, so I could argue that a lot of people do not have financial accounts because they do not have trustworthy information being measurable and recorded in an account. So cash and collateral still are the hard currencies. Now, if you look at if you look at business lending, then even in the United States, about 60% of the commercial and industrial loans are secured. And a large chunk of the SME loans SMEs are financially constrained because they do not have enough collaterals. And the progress of the microloans is not advancing as far as we have hoped, presumably because the cost of collecting and verifying information is not very scalable in a traditional way. If you look at consumer lending, very similar that even in the United States, about 85% of the consumer loans are secured. And the part of the non-secured the loans, the consumer credit is very much related to the payment, and that requires a high cost of collecting and processing information. And finally, if you look at the wealth management, Piketty's point is well taken that the wealthy people get wealthier because they have money to invest. The average people, they underinvest. One key reason is because of lack of trustworthy information. So as we can see that information has been a major obstacle in finance because again, finance is a service based on individual information. Now the question here is what can digital technology do in this regard? So I'm going to make 4 claims. I think there are major trends that can describe what's going on. The first, then I'm going to provide some evidence to verify those claims. My first claim is that there is an information revolution. There's a break point around the arrival of the mobile internet. We've been talking about the information revolution for a long time, of course. But I think really what's taking off is the arrival of the mobile internet, because right after that, both the consumption and production behaviors becomes much more measurable, tractable across space and time. And that goes with the rise of the digital finance. The second major trend is the capacity transformation. Starting from mobile period, I think the digital revolution is deeply transforming the accessibility and the risk assessment and the risk management of finance. So both the supply and demand of finance become much more real time. So that's the capacity transformation. The third major trend is the integration of finance with the real economy. So the rise of the digital finance goes with the pace of the digitization of the real economy. But of course, the interesting thing is that they don't exactly take off, like I think Daryl mentioned earlier, because the pace of the digital penetration is actually an art. It depends not only on technology, it also depends on unsatisfied demand and habitual resistance from that country. So it could be very complicated. And finally, I think a major trend is the open finance. the rise of both the digitization of finance and the real economy requires that the many financial institutions and the fintechs, they have to work together because they have different strengths to serve the same customers. So open finance is becoming more and more inevitable, even though there's a lot of competition between them, but it's really, there's a lot of need for them to work with each other. Now, let me give you some of the evidence we're seeing in China. Let me first talk about mobile payment. Now, if you look at the first graph on the left, you can see that in the past 6-7 years, actually, it's Asia's non-cash payment, is the mobile payment really grows the fastest. So it's not every continent grow exactly the same speed, but I think that's led by China, India, and some other Asian countries. Now, if we look at China, then you can see on the right hand, you can see where is the breaking point I'm talking about. Back in around year 2010, 2011, China's e-commerce as the portion of the retail is only about 1% of the retail sales in China, which is actually below United States and many other countries. At that time, China's mobile payment is very similar to United States. One is 15 billion, another is like 8.3 billion US dollars. But then China in the past 10 years or so, it just really took off. It's right surrounding the mobile internet period. So I agree with some of the previous speakers. This is particularly meaningful for the developing regions. They can pick up the technology and grow faster. This is something called inclusive growth. Now, so that's the mobile payment. And another really interesting story is the battle between the QR code and the traditional point of sales machine. Now, in traditional payment method, you really have to have a point of sales machine that try to collect information from different parties and verify the information. It's costly. And it also requires every merchant to have, in China back in 2011, it requires every merchant to have the deposit above several thousand RMB to have that POS machine. And for every transaction, it charges 1% to 0% of fees. Now, if you use the QR code, of course, then there's zero collateral and the fee, the payment becomes much lower and it's real-time settlement. So that's why even beggars now use the QR code because that's their modern time POS machine. And so, but it's not only just that it's much cheaper for the merchants and for the customers. Actually, it's much safer too. Using the alternative information, just Manju and other speakers just talk about, really, you have the real-time risk management. So if you compare to the traditional, the payment methods, the fraud loss rate was about 0.0%. But really, if using the mobile payment, using the alternative data, real-time data and risk management, then your default rate becomes several scale. It's just, I cannot even pronounce that number. You can look at it, but it's just the several scales much lower. So that's why I've never met a single person in my life that has the fraud loss happened in mobile payment. Now, so that's what I'm trying to talk about is that the information and digital technology really has changed how payment is being done, become much more inclusive. But not only that, but now you have, because in the beginning I talked about financial account, now you have a mobile account. Now the mobile financial account, that really means that it has a remote identity that is trustworthy. So that can spur a whole list of the innovations, including sharing economy. And including unattended retailing. You can buy things, for example, this is the interesting paper studied by Ouyang, who is a PhD candidate from Princeton. He's been working at the Luohan Academy for about 2 years now. And you can see his work. You can see that in this graph, you can see the interesting question here is that if you want to develop the mobile payment, should you start with the supply side or demand side? That's the art of the network. So here that is looking at for the horizontal access tells in a city that has a lot of new bicycles, the bicycle sharing. But you can see that if the bicycle amount is very small, then the activity of the users doesn't take off. But really, with some supply side of the bicycle, then it's really the whole thing just take off. And when the customer becomes more active, then actually that effect of the data spill over to the ability for them to get credit. So that's the wonderful part, the kind of the footprint that brings more additional financial availability in this particular case. Now, so that's some examples on the payment part. Let me say something about SME lending. Now, in the SME lending, in the traditional way, we use the hard information, structured hard information, like the credit score Manju just mentioned earlier. But what we're really seeing in practice is that a lot of the efforts have been used to find the hard information in soft information using the alternative data, and also turn a lot of the alternative unstructured information into the structured data information. So in that way, it becomes much more useful. You can call this the deeper alternative score. In this way, then you suddenly make and because that method is actually very scalable. So that becomes a new way of providing the credit service that is the scalable and sustainable. So you can see that then in the past 10 years or so, with our experience at On Financial, they have my bank has served more than 35 million SMEs, and half of them are women entrepreneurs. You can see that actually the percentage of credit divided by the per capita scale by GDP is the less developed regions, they have higher share. So that is really inclusive in this way. And also, just now, a couple of the speakers worry about that if you have kind of AI to screen the customers, that leads to discrimination. And actually, indeed, the Thomas Philippon had a similar concern last year. If we look at look at the age group, education group, gender group, we do not see that happen. So at least in evidence here, we're not seeing, and this is really large scale evidence, we're not seeing that thing. Now this is other paper by Professor Huang Yi. I believe he's still online today, and what he shows is that those SMEs, if they are able to use, because of the alternative data, they're able to get the lending without collateral, as Ben Holmstrom famously claimed, information is the new collateral. And so here you can see that then that's very beneficial to those firms that are able to get those non-collateral lending because of the data. And so, and finally, what I'm showing here is that this is not just providing to those SMEs, the ones who are lacking the data, but lacking the collateral, but actually it's kind of safe, because you can see this is a delinquency rate, a 90-day delinquency rate. It's clearly below the rural commercial banks, comparable banks, or the city commercial banks. It went up a bit during the COVID period, but it still goes down because of a real-time risk management of the data. So you can see that this is a sustainable thing to do things. Now, let me spend a little bit more time to talk about consumer lending. How much time do I have, Sanjay? 2 minutes?
2 or 3 minutes, is it okay?
Good. Yeah, should be fine. Yeah. Okay, let me talk a bit about the consumer lending. The consumer lending is very similar. You can see as I mentioned, so you can see that the left graph here is the shock to China's consumption during COVID. Then it kind of recovered after that earlier last year. Now, if you compare it to the right hand picture, you can see that compare the people using the credit pay and without using the credit pay. But what you can imagine here is that, as I mentioned, in the consumer lending tends to be a lot of those uncollateralized the consumer lending is very much related to the payment. But here, because payment becomes much more powerful, because so much more real-time information, you can see that it helps the lending a lot. It really benefits the people who are using it. You can compare the people who use and who do not use credit pay. You can clearly see that the ones using it, they get hurt much less during the COVID period. So that's on the demand side. On the supply side, because it's actually credit pay, it connects the supply and demand. You can see that on the supply side, if you compare the merchants who accept the credit pay, then compare with the ones that do not accept, then clearly the ones do not accept get really hurt. Now, if you think this is indulgent by the ones who has higher penetration and lower penetration of credit pay, you can see that the ones have the higher lower penetration, the deeper color, they got hurt again more during the COVID period because of the distancing hurting. Now, and this graph shows that if you compare the regimes, in the regimes with higher GDP on the right-hand side, they tend to use the credit card, accept credit card even more. On the left-hand side, with regimes with a lower GDP, they accept the credit pay using the alternative data even more. So it's really complementary to the current financial system to make it more inclusive. Now, finally, I want to say something about open finance. I think that's also very exciting. Now, what I observe on Alipay's the platform, we can see that. So let's look at the numbers. Now, by the end of last year, it has close to 200 institutions on Alipay's the wealth management platform. It has 170 million investors. So it's all those institutions, the customers. There's 51 million users that watch a lot of live stream shows, and they have this 6,000 professional investors, advisors, and there's a lot of hundreds of millions of contents and videos produced. And so it connects the investors and financial advisors with the financial products. And it's for the first time I've witnessed, I've been lived in the US for a long time. I think it's first time I can see that people have very little money, $10, they can have a real-time financial advisor to help them go through up and down. It also has with the hope of, so investors can get help from education content, discussion forums, news analysis, select different products. They also have robot advisors. So that put together is the platform nowadays. Now you can see that these are the contents put out by the financial institutions. They are really spend a lot of time to make their contents really interesting to attract their own investors. And then the next is that I think every Chinese know that live streaming is extremely popular in China. So all those professional analysts tell the customers they have very little money or a lot of money, tells them exactly what's going on to help them to go through up and downs. And also we have they have their own online forums for the investors to talk about what should they do, what should they buy, etc. And though they have the robo advisors these days that they're doing very cool things to help them start from every step of helps them to improve their financial literacy and for decision making. Now my time is up, but my intent to give you a glimpse, I'm trying to answer the question of what information revolution is doing to finance. So I'm making 4 claims. I think, of course, there's information revolution, but my first claim is that I believe that it's really taking off around the arrival of the mobile internet, because at that time, both the consumption and production behavior becomes much more measurable and trackable, and with the rise of the large scale of the digital finance. The second part is that we can see clearly and consistent with previous speakers that we can see a lot of alternative data. Wonderfully, it changes converts soft information to the hard information, unstructured information to structured information. By doing so, we can see that it's deeply transforming accessibility, risk assessment, and management of the finance. So both and supply demand becomes much more real time. And with that, the digitization of the finance is being increasingly integrated with the real economy. Of course, it depends on the country. And this is, I agree with previous Sumit, that this is particularly wonderful for the emerging markets where there's a lot of unsatisfied demand and more attitude to embrace digital technology. And finally, I think because of this integration between the real economy and finance, really only finance is not enough. You need a lot of technology, a lot of connectivity. So that means that the financial institutions and fintechs, even though there's competition, there's a lot of room for them to work together to have the open finance that is become much more inevitable. That is the future happening right now.
Thank you very much, Long. Let's go to Robert Townsend for his thoughts, please. Long, maybe you can unshare the screen, please. Yeah, perfect.
Can you see this?
We are not seeing anything yet.
Oh, that's not good. So thank you very much for asking me to participate. It's really quite a great event and a panel, and particularly to discuss Long Chen's paper. So we had talked, Long Chen and I talked last week, so I wanted to pick up on something related to what he had said and his talk today, which is what's the big deal about payments? So one premise, it's really all about the data. So if you think about digital payments, it's a log of transactions and like a cash flow statement. And indeed, that's exactly how we create ledgers in financial accounts. By having the underlying transactions data, you can run checks, the balance sheet becomes integrated with the income statement and so on. So you can actually get, in principle, the financial accounts out from digital payments. This has various desirable features. First of all, changes in the stocks of assets would be consistent in the flows, you know, whether or not you own it, if you own it, did you use it, and so on. And shockingly, let me tell you that no of the many famous and deservedly well-known US micro surveys, absolutely none of them meet this standard in terms of the consistency of stocks and flows. Another good feature of the payments data is that you're reconciling transactions across parties and doing it instantaneously. Now, to harken back to something Daryl said, this actually gets harder when you have multiple payment providers because you will have multiple databases. And so one can think the big picture, which is how do you create better information infrastructure in the US and other places. And I would propose that there are many insights available from data science if we're thinking about better designs that deal with synchronous versus asynchronous, was something we've got used to from Zoom and lecturing, but it has a different meaning here. Centralized versus decentralized systems and the difficulty of scaling, as in completely centralized. Computer scientists refer to these as CRUD systems, where only delegated people have the authority to create, read, update, and delete, with potential problems therein, or the decentralized systems where there are theorems about the impossibility of having both consistent, available, and partition tolerant systems all at the same time. So this slide is at the heart of Long Chen's comments. Payments, it doesn't stop with payments. From payments, you get to financial access. And this is not a new idea. The G20 adopted this as a formal part of the agenda years ago. And of course, from financial access built on payment systems, you get to impacts on the real economy. And vice versa, they all become intermingled together. So an example of this in Africa, well known is M-Pesa, running on a private system, Safaricom. But let me point out that it's actually tricky in many contexts to make the conversion from pure paper currency to these e-money systems. An example would be CBDC and the Central Bank of Bahamas. They have it, they're doing it. But if you listen carefully to the comments of the governor, they've actually had problems in more rural and remote islands getting people off of the currency. There are, of course, success stories, and Alipay is one of them. And you've heard already this morning in Long Chen's talk, credit reaching tiny businesses operating in small markets instantaneously, including beginning of day borrowing and end of day payment. It's quite remarkable. Alipay also has run insurance portals with millions of users and has mutual aid through its system, as with COVID injections, the wealth management platform you heard about, and the commerce that takes place, e-commerce and so on. But that actually links back to the real economy, because beneath all the e-commerce lies the real shipping logistics and so on, where Alipay has also made considerable investment. Another success story to balance this thing a bit is Pix in Brazil. They're making great strides. They require their commercial banks. And Daryl again was saying, how do we get banks to do this? In the US is one thing. In Brazil, they just mandated it. And I don't know the back channel story of how, you know, they overcame the political economy forces, but all banks are required to offer electronic banking. And it's not just payments, as in Pix, they're building up credit registries. I think something akin to Alipay. Okay, but still caveat at the end, it seems to me there's a dangerous allure in these new technologies. The question is always, what are we trying to build, as in the applications? Insurance is potentially different from credit, is different from wealth management, but there's a tendency to think that one can separate engineering, as in coding up new CBDC for the US or other places, as separate from the economics of what we're trying to accomplish. So we must bring the economics and the technology into it jointly and focus on the applications, rather than thinking we're going to design some universal, a priori, all-purpose system. Another way to emphasize what I think is a danger here are the buzzwords, which we hear in the US and other countries. Fast payments, great, what's wrong with that? Real-time gross settlement, atomic swaps of assets, as if these were the desirable features, and they can be, but they do come with problems that we are aware of already, namely liquidity problems, you know, managing, no one holds enough liquidity to be able to honor all the payments that are at the beginning of the day in a given central bank. It doesn't happen. People, systems economize on liquidity. Another issue that was raised earlier is the information revelation problem that can come with atomic swaps. So there are actually trade-offs with new versus legacy systems that need to be thought through carefully. So my last slide, I deliberately have only 3. I want to touch on what I think is a very misleading debate about information, because you will hear it said that we have to preserve privacy. That's paramount. In Europe, but also US, other places, you'll also hear that a la Hirschleifer, you know, once information acquired, it should become a public good. So data as public poses a dichotomy, as if we had to choose one or the other of these systems. And it's not the case. Encryption allows data to be kept private, but nevertheless allows analysis of the data in these encrypted homomorphic spaces. So the computer scientists have excelled in multi-party computation and fully homomorphic encryption. And you can run the smart contracts as part of applications on these encrypted spaces. So now again, we need to make choices depending on the applications. Others that haven't come up so much yet, you can have auctions to allocate financial products and so on. You can run those auctions without auctioneers. You do not need trusted third parties with everything encrypted, actually. You can get insurance and embed that within these credit liquidity systems, and you don't need the planner of mechanism design. You use the guidelines for mechanism design and implement through encryption without the planner. You can get aggregation of data on the ledgers through encryption. So even though all the accounts are private, you nevertheless have some aggregate numbers can be used by private sector and government and so on, and you can securitize small and medium enterprise debt with these new technologies. So let me just conclude with a word about the nature of competition, especially on this slide having to do with information. When we talk about open competition, we should make a distinction. My experience is that what works well is ex ante competition among private, maybe in competition with public, for the rights to provide services, but not ex post competition, not siphoning off customers who are under a given contract, because that can undercut desirable incentives. Similarly, you can have platforms mediating trade and so on, but the information collected on the platform should not be under the auspices of the party running the platform. For example, if they sell statistics for gain, that can actually create an adverse incentive effect. This is the paper with Antoine Martin and Michael Lee. Likewise, you can program information and actually deliberately keep some of it private, which relates to Akerlof's lemon problem. If there's too much information out there, then basically the market can shrink to zero. But here you don't let a private party do it. You pre-program it in code, so that it's the decision about how much information is being released to investors. And finally, let me just say, this is not meant to be a contest between the public and private sector, as proposed the comments about Diem and so on. Distributed ledgers actually are helpful to regulators in allowing solutions to problems like coordination and runs on markets and so on. So let me stop there.